Good afternoon, and thank you for joining this last session for today. Sponsored by Kyriba, a company which has been helping over 2,200 clients transform how they activate and protect liquidity-based software. Now, today we'll be hearing from global management consultancy who will discuss the importance of optimizing liquidity in the market and what companies and the boards are doing to maintain liquidity and cash flow. Leading SaaS treasury and finance solutions provider Kyriba will provide insight into how its clients are freeing up working capital, gaining real-time visibility into the company's liquidity profile, and how they're supporting them in this business process. They'll be joined by GVC Holdings, who will outline what is during the crisis, describe how they're able to meet the challenges and successfully continue driving the business forward. After our discussion, we'll have a Q&A session where you can ask questions through the app. All questions are anonymized, so please don't be shy. Now, I'm delighted to welcome David O'Neill, who's the Senior Vice President of McKinsey, Neil Cotter, Director of Treasury for GVC Holdings PLC, and Wolfgang Koester from Kyriba. Now, David is a McKinsey's RTS practice with 15 years turnaround and restructurings, focus on sustainable high-impact improvements to profit and cash generation. Is a fellow of the Institute of Chartered Accountants for England and Wales. His experience in treasury spanning companies such as Logica CA, ICI, and Morgan Advanced Materials. He is now the Director of Treasury for G Holdings, a FTSE 250 company, one of the world's largest sports betting groups, a force of more than 20,000 people operating in over 20 countries across 5 continents. And finally, we have Wolfgang Koester, who's a Chief Evangelist at Kyriba, with over 30 years experience in currency markets and working for Fortune 1000 companies and government entities. Wolfgang will guide us through today, and we'll take questions at the end. Wolfgang, over to you.
Hey there. Hello, everybody. Welcome to the last session today. And we were commenting earlier that when we've had these sessions before, by now it's 4 o'clock European time, or 5 o'clock that is. So I'm sorry we're not having any happy hour here, but hopefully we'll have a good session here today. Really excited about this session because it really looks at how boards and C-suite are thinking about treasury and the strategic inputs that one has to give and one gets from companies like McKinsey. So the input from both David and Neil are going to be very insightful to this. So for this, I'd like to start off with David. Why don't you give a little bit of background and as you're thinking about treasury?
Yeah, sure. Thanks, Wolfgang, and sort of good afternoon, everyone. So yeah, I mean, I think first thing, it's obviously been a busy few months this year with the evolving sort of crisis engulfing the world, and I think we've really seen a shift in what we're hearing from the C-suite and some of the things they're interested in. I think there's probably 3 things, and I'll sort of explore those over the next sort of few minutes or so. I think firstly, C-suite members are increasingly concerned and wanting insight into what is their current exposure, what is their sort of current liquidity position. That's firstly. I think secondly, we're getting a lot of questions around how do we survive through this crisis. What are some of the levers we should be looking at to sustain our liquidity position. And then sort of thirdly, C-suite teams are now thinking, actually, once we've got through this, how do we then sort of recover and then start to reimagine the new normal? So let me just spend a few moments just exploring each of those different aspects. So I think the first thing around the liquidity is that we've seen liquidity quickly move to the top of the board agenda from being, frankly speaking, either very low on the agenda or slightly off the agenda. We're seeing a design for much more faster, better, more frequent, more granular sort of transparency around cash and liquidity. And as part of that, we're seeing C-suite members increasingly wanting to drill into things like 13-week cash flow forecasting, really understanding the drivers that are going on in the business. So who are the suppliers they're paying, when are they paying them, what's happening around their sort of collections policy, what are they doing around sort of capex, what's happening with the FX exposures, etc., etc. And so then we're seeing much more desire to get better understanding and deeper into liquidity positions, headroom, covenant testing, etc. And I think also as part of this, we're seeing sort of questions around, or a desire for, having better systems that are sort of joined up, more automated, that can provide, that rapid, quick view of cash around the whole organization, around the globe. So they've got that visibility and also that information to make sort of very quick decisions. And I think, some of the things we have seen is that, where we don't have those systems, that there have been sort of challenges in place in terms of supporting C-suite members with that sort of information. So that's sort of the first point I would just make around sort of, liquidity, in terms of what those desire, what the C-suites are currently sort of looking after. In terms of sort of the second point around, levers, and how we get through this crisis, again, we're seeing a strong desire from the C-suite to make sure they are working with suppliers who are sort of stable suppliers, particularly around sort of technology areas, around core sort of raw materials, good suppliers. So there's a big desire to have that sort of sustainability in there. There's also been a sort of increasing amount of work done around sort of customer management, and it's interesting how this crisis is different to other ones, where traditionally there'd be a much more harder sort of focus on managing those customers, whereas I think given sort of the current situation and environment, it's been a much more sort of softer approach to sort of customer management. So we're seeing some slightly different sort of tactical movements there on sort of the cash levers. And then sort of thirdly, we're seeing a lot of activity around sort of tactical decision making, particularly around rent and sort of how people are dealing with landlords. Obviously, lots of different jurisdictions are getting sort of government subsidies, so things like employee furloughing schemes and so on, and of course, and obviously refinancing as well. So I think then in terms of what we're hearing from the C-suite, and therefore what that means for treasurers, is we are now seeing them having to move into much more of a sort of strategic role. We're seeing treasurers, how acting as more sort of driving the actions, coordinating activities, across an organisation, helping to actively manage that sort of liquidity challenge. Seeing them much more demonstrating being more in that sort of bias to action rather than sort of a reactive or sort of reporting role. And also, I think we're seeing, treasury departments coming much closer to finance teams as well, particularly around sort of planning of financing, looking at what exposures we want, how do we manage those different FX exposures around the business, what are the right financing facilities we need in place. So we've seen a much more sort of joined up sort of collaboration. So really interesting how we've seen over the past few weeks and months those requests coming from the C-suite around better liquidity, better insight, making sure do we have the right systems in place to support that visibility, driving then sort of cash and liquidity improvement opportunities around the organisation, and then increasingly how treasurers themselves are playing a much bigger role from a strategic perspective in terms of driving that activity and coordination across the organisation. So I'll just pause there for a moment.
I think those are some very important details to talk about, and I think we're going to get further into these as we talk about Treasury becoming more strategic. The levers, we're definitely going to talk some more about the levers there, and as well as, quite frankly, the systems and the visibility that people, quite frankly, need and have become mandatory and mission critical versus having nice to have. So I think that'll be an interesting discussion to get into here pretty quickly. But thank you for that, David. Before we hand this over a little bit to Neil, a little bit of discussion on my part about really what we're seeing. I sit on boards, I advise boards, I report on the boards. So I spend a lot of time also with customers on the C level to really talk about finance. And I think to David's point earlier, and I think McKinsey overall sees that as well, as I'm sure Neil will talk about in a minute, is we're seeing the Treasury stepping up to be much more than and I'm sorry if I put it in those terms, that the cost center that they were seeing prior to a crisis like this. They're very strategic now, and they're being asked to really be more than treasury, in my opinion, and to really be looking at as finance solution to many things and pulling all these things together. So absolutely at the center of all this under this fire is certainly liquidity, and we'll get into some examples of that. And with that, it's also talent. I think it's really important to keep focus on the key talents that people have and the companies have and how they've had to adjust and what they need and the tools they need, quite frankly, in order to do their jobs. Because right now, manual processes with everybody having to overnight go home really didn't seem to work very well, and they're causing a competitive disadvantage in their industry if they've had to be manual processes. So I think that automation here is playing a big role, and really the shift from manual processes to being 80% and then 20%, quite frankly, intelligent input, to spending very little time of gathering the data, but spending a lot of time really analyzing the data and making good, solid decisions. So, for example, when we talk example, and we've seen this often, for example, at companies who have a lot of equipment, they may have said, well, you know, in the good times, they had the equipment in their revolvers. And as they now had quickly the data, they saw that let's take those out of our revolvers, put that in an equipment financing facility to free up more cash, because obviously cash is king here. So I think we're going to spend some time on those and some questions. But before I do, I'd like to hand it over to Neil and kind of give us his background and opinions. And I'm looking forward to that as well. Neil? Neil, we can't hear you if you're speaking.
Thank you, Wolfgang, and good afternoon, everyone. I would also like to echo David and Wolfgang's comments about proactivity and automation for Treasury. But first, let's travel back in time to late January, when mysterious stories appeared about a new type of bat flu in a remote location in China. I mean, it's hard to believe that in 3 short months, how COVID-19 has jolted our lives, the global economy, and of course, corporate Treasury. So how did it impact GVC and Treasury? And what is our short-term liquidity action plan? How will Treasury's role change in the future? As Naresh mentioned, GVC is one of the world's largest online gaming businesses, with well-known brands such as Ladbrokes and Coral. We also have several thousand betting shops, principally in the UK, but also in Belgium and Italy. All shops closed in March due to COVID-19. This is the primary adverse impact for the group. Sports events were also postponed, which would impact online revenue. On closure, our shop revenue immediately fell to zero, while significant costs, of course, continued to be incurred, such as rent and salaries. Offices were also closed in all of our worldwide locations, such as India, the Philippines, Australia, and the USA. So priority one for the exec was business continuity, ensuring employees were safe, staff productivity continued, and people could work remotely effectively. Critically, online systems for customers needed to remain resilient. But priority two, close on the heels of that for the exec, was managing the cash flow and debt implications of the shop closures and sports postponement, i.e. a short-term liquidity action plan. The key focus here was to reduce cash burn down to zero during the lockdown. So the government furlough support and business tax relief helped significantly in the UK, where a good deal of our retail revenue is. There were opportunities to defer taxes such as gaming duty, VAT, and PAYE, which we've taken advantage of. We are in fact one of the top 20 UK taxpayers. We cancelled our dividend, and all CapEx and operating expenditure was individually reviewed and put into 3 buckets. Can it be stopped? Can it be delayed? Can it be negotiated or restructured? And then we classified each of those expenditures into the impact it had on EBITDA, both in the short and medium term, to establish a priority. Accounts payable payment runs were closely monitored and acted as a driver for renegotiation of contracts. And all payments, physical payments going out, were then resubjected to sign off by divisional heads. Simultaneously, we introduced weekly reporting of cash flow and net debt to the exec, together with cash flow forecasts out to end of 2021. Here, Treasury's ability to collect and classify cash movements down to individual bank account level gave the immediate details which accounting systems struggle with due to their focus on monthly reporting cycles. This was significantly aided by our implementation of Kyriba's Swift Alliance Lite 2 payment hub in 2019. We now have 95% visibility on a daily basis of our worldwide bank accounts. This enables a straightforward process, maximizing automation and removing risk of error. And I don't think that's any mean feat, as we have over 50 active banks and over 1,000 bank accounts. This cloud solution also means greater system stability for us and the removal of reliance on internal IT support for server upgrades. So that's the cash flow. But what about debt maturity, covenants, and cash management? So turning to maturity, with no significant debt maturities until 2023, an undrawn £535 million revolving credit facility and substantial free cash, this was not an issue. There was no need to consider government financing options. But it is worth noting that BB credits, such as ourselves, saw euro financing costs escalate from 2.5% to over 10% in 2 weeks. Thankfully, they have fallen, but still remain elevated at around 5%. And we found the use of the floating rate term loan B market has proved very helpful here in ensuring that we can opportunistically term out debt well ahead of maturity and not concern ourselves with make-whole premiums or doubling up on refi costs prior to debt maturity. Turning to covenants now. The next question impacting liquidity: how do our debt covenants fit within new reality? Uncertainty over the length of time of shop closures meant that it made sense to seek loosening of leverage covenants whilst the pandemic is ongoing and impacting our EBITDA. So we immediately engaged with our lending banks and rating agencies and provided a cash flow and EBITDA forecast out to end 2021. A clear financial projection sufficiently detailed to be presented to internal credit committees was critical in quickly obtaining bank support. We achieved a successful RCF financing in late of April last month. Finally, on cash management, centralizing cash is business as usual for treasurers, but COVID-19 has made the case for automation much stronger. Alongside the integrated and automated cash reporting dashboards, we now use Kyriba Swift Payment Hub to seamlessly move cash between all of our main banks via a single login. We can now effortlessly and seamlessly and securely move money to the right account and at the right time on a daily basis. So I regard this as a single surrogate cash pool across all our banks. We can enable swift payment instructions from our own BIC and automatically create payments to rebalance the pool across banks without the need to manually enter transactions. This removes errors, saves time, and critically provides us with scalability for our future banking network. So we are currently at the moment implementing the Kyriba TMS modules so we can add in investments, loans, and intercompany positions into our actionable dashboard. And it's great that we'll have the TMS and the payment hub on the same SaaS solution. One other question asked by the exec: should we fully draw on the RCF to protect liquidity in the event of lender default, and where should we place our cash? And we decided no. Although we normally use credit ratings for assessing default risk, given the volatile situation, we focused on the credit default swaps of our lending banks. Bank CDSs did double or even treble in March, but remained well below levels during the 2008 financial crisis. So we kept a watching brief and sensibly did not draw the RCF and suffer the 2 or 3% additional cost of overborrowing. As a precaution, we did switch surplus cash from banks into AAA instant access money market funds. But as CDS rates are now more sensible, we have largely moved back to banks who are offering superior returns for 14 days and beyond. In conclusion, this extreme event has emphasized criticality of treasury being fully integrated with all parts of the business and not just a specialist area for raising debt, managing FX and investing cash. Over the years in previous companies, I have witnessed liquidity stress where treasury escalates up the priority of a board only then to fall back in priority once the crisis subsides. I think COVID-19 is different in that many businesses are being impacted simultaneously. Once the situation has subsided, I'm sure this will give boards time to reflect and put Treasury nearer the top of the agenda. The imperative to broaden Treasury's remit into a more strategic role, as the other speakers have suggested, is thus compelling in my opinion. So I'd like to hand back to you, Wolfgang, now.
Oh, thank you so much. Well, there's a lot of stuff. If you get to take all the notes on that, luckily there'll be recording on that. At least first part of it, I kind of thought, wow, is he really treasurer? Is he CFO or on the board or any of these things? I mean, you really touched on a lot of topics here. And it kind of reminds me, and I'd love to dig into some of these things, as you talked about cash flow, then you talked about net debt, then you talked about debt maturity, then you actually ended up talking about covenants, which I'd love to talk about. And then one of the things you talked about, which I think is a bit unusual, is I think if I was going to say, what did the majority of companies do? They all drew down their lines immediately. That's the vast majority. So it's very interesting that you guys made the decision not to do that, because that would incur excess costs. So you really had a lot of things on there. But, take a step back on this. When I hear all these things, your business changed completely. How were you able to analyze all these and really act like this? I mean, to get access, how did you have access to all that data and all that information? How was your team so quickly done? Could you give us a little bit more insight on that? Because it's really fascinating what you guys did there.
Well, what helped there was we've got a senior finance leadership team who meet regularly. And so we have a close integration between treasury, financial control, procurement, investor relations. So I think because you've got that close-knit team that meets regularly, it means that we can act very quickly. I think that all helps in getting things done quickly.
Fascinating. Well, let's take a step up. And David, that'd be really interesting. One of the things that Neil talked about was debt maturities and focus on really time horizons. Can you give us a little bit of background how you guys think about time horizons for customers right now, thinking about forecasts versus the balance sheet, monetary asset liabilities, et cetera? What are you telling your customers?
Yeah, no, it's a really, really good question, and I think a really, really interesting point. So, and I think it's fundamentally two horizons which companies are currently looking at the moment. I think one is immediate near term. I think what we are seeing out there is a lot of distress about to hit. We are seeing a lot of pressure building, and frankly, a lot of shortfalls predicted over the next 3 to 6, 9 months, so through to sort of 2020. So I think the first thing is there's definitely a huge focus from boards, management teams, finance treasurers to one, really understand, what is the immediate problem they're sort of facing, size, and what's the timeline. So there's a huge focus on 13-week cash flow forecasting. And I think sort of building some of the points, Neil made, is how these things quickly go up the agenda, and then when things return to normal, things quickly come off the agenda. This is a very good example of, I think, every situation I've been involved in so far this year, no one has really been doing any sort of cash flow for 13-week cash flow forecasting. And so people have been rapidly trying to sort of build up those forecasts, don't really have the systems to do it. So it's back to traditional Excel spreadsheets, so it's very clunky, very slow. But there's a real need to get that accurate, robust, and be doing it on a weekly basis just to manage through and survive. I think then the second horizon that companies are looking at, as they now start to think through, okay, let's we've got a view, we understand the problem we need to solve for in the near term. How do we now prepare ourselves and recover and reimagine the new normal? And that's where then companies are also looking at that sort of 2, 3, 4, 5 year horizon, and really starting to think and using this as an opportunity to reimagine their business. So we're seeing a lot of discussions around, okay, what is the right operating model I want to be having? What suppliers do I want? What do my supply chain need to look like? What markets do I want to be in? And really bringing forward some of those conversations that were 3, 4, 5 years out, and now having those conversations now. And also a big part of that is then thinking, okay, in terms of what does our supply chain look like? Well, what sort of financing do we need to have in place? What do the FX contracts need to have? So one of my clients at the moment, we're exploring opportunities around supply chain financing. So it hasn't been on the table, very much now on the table as a point of discussion. Similarly, in terms of looking at what are the markets we want to be in, and companies thinking about what exposures they want, both from a customer point of view and a supply point of view. I mean, if we think back to January, there was huge concerns around the supply chain with China and what that meant. And so people are now thinking, is our supply chain right? Do we actually need to do more onshoring, or at least bring it closer into, if you're a European business, bring it closer into Europe and have less dependency out to places like China? And again, that has huge implications for, FX contracts we have in place, what new sort of arrangements we need to place, how do we sort of finance those? So I think we're very much seeing a sort of a two-tone sort of conversation. One is very much on having that immediate liquidity and really having the richness and robustness of the information to drive the conversations, to manage the business, sustain it through the crisis. But I think increasingly, management teams, less so probably 2-3 months ago, but increasingly now, people are much more thinking through, okay, once we get through the next 3-6 months, now let's position our business for the next 2, 3, 4, 5 years, and really starting to plan that now. And again, I think we're starting to see implications for treasurers. And again, it comes back to this theme of having that sort of strategic role and starting to prepare for the future now.
Yeah, very interesting. It's interesting, both you and Neil talked about pretty much the same 4 areas I call. We didn't talk as much, Neil did, on the supply chain financing, which I don't think in your business, Neil, will be as, but I'd be still interested in whether that's so important. But what we at Kyriba, if I may say this for a second, when we looked at this and continued to have these conversations, this was bigger than just treasury management system and enough there. This was really starting to evolve into an active liquidity network, where you had to talk about cash, where you have to talk about payments, where you have to talk about supply chain finance, where you have to have risk, where you have to be able to integrate all these. If, for example, you, David, you're just talking about supply chain finance. If you have a supply chain finance module and now you're doing that cross-border, would you like to have cross-border payments associated with this? Because I think the theme that I'm hearing from both of you right now is that Treasury's expanding a lot to become an absolute finance function, really much more strategic. And I think that's really important for the audience to really hear, is that this is, the area is expanding. You kind of are in the eye of the storm, so to speak. This is very mission critical. So supply chain finance, for example, one of the things that we've seen a lot of demand increase on 3 areas. One's on the corporates, who are saying, listen, we need to figure out what suppliers are critical to us, and we need to figure out how to help finance them to keep our supply chain going. Then they've seen the banks coming to us and saying, listen, we want more technology to improve our technology so we can offer that to the corporates. So you see corporates buying supply chain finance, but you're also seeing the banks putting programs together, leveraging technologies in order to service the customer better. And then third, you're seeing an increase in the governmental part, where infrastructure payments, et cetera, infrastructure financings are also increasing. So going back to this a little bit, Neil, of course, first my question, supply chain finance, not as important to you?
It's very limited, actually. It would only be in sort of probably technology cost for our computer equipment, I think, but we don't really have, we have end users as customers who deposit money, and we don't give credit, so it's, there's no, product. So.
Can you expand a little bit about covenants, and as much as you can educate us on what you can divulge? But one of the things that I kind of, in the conversation that we've had with C-suites and boards a lot is talking about, David, I'm coming to you on these too, on covenants, really going back to the basics, where you're looking at liquidity ratios, where you're all of a sudden, for manufacturers, subtracting inventory out of the assets and then dividing it by liquidity for lenders to get a better idea. What have you seen? What have the covenants done? Have there been increased on the focus of them? And if so, on which type?
I think a lot of the concerns over covenants came from the equity market. So when the crisis hit, the first thing the equity investors wanted to see was, are you going to run out of cash? And are the covenants going to impact your liquidity position? So that was an initial question that came out from an equity side, because I think that was the first question that got asked by all businesses who had some kind of impact from COVID-19. And of course, we were on that anyway. And as I said, we adjusted our covenants slightly to take account of the change in our forecasts going out to 2021.
Very interesting. David, what are you guys seeing? What are you guys recommending on the covenants?
Yeah, so just to build on what Neil said, I mean, what we've seen with clients is definitely sort of an increased focus on monitoring covenants, so whether it's debt leverage, fixed cover charge ratio, interest, etc. But I think as part of that, what we are seeing is a lot more sort of scenario planning to really understand, if we have these pressures on our top line, if the lockdown happens for this long or it's extended, if the recovery is more subdued, etc., etc. So we're seeing, I think one certainly increased monitoring, but two, a lot more sort of scenario planning, just to really understand what the sensitivities are to the covenants. I think at the moment, not seeing too many sort of requests for any amendments to covenants yet. There's certainly a lot more sort of focus and planning around those. So yeah, people really keeping an eye on those. And I think as part of those, we're seeing companies, keeping in close conversation with their lender groups.
I think the other thing also with covenants is they're operating off history as well. So it's, your last 12 months. So things happening in 2020 will impact your covenant in 2021. What's your financial position going to be in 2021, where there could be a high degree of uncertainty. So I think it's incumbent on companies to make sure that they, as you say, they've got sufficient headroom and flexibility there to, as you said, to cover scenario planning.
Yeah, no, I completely agree. I think that one of the things that we're seeing is really people focusing on the shorter term, the quick ratios and some of those ratios, and having the ability to get at good data, and with that data have better information to make better decisions at the end of the day, right? That's what the systems are about. I think that one of the things that we're also seeing, I'm very interested on your thoughts on this, both of yours, is what we refer to as the velocity of money, really a concept that came out of the late 70s through the mid 80s about looking at, from a governmental point of view, looking at GDP versus money supply, but in the corporate world, obviously looking at revenues versus speed. But as we're thinking about this economy going back, really the words velocity of money we're seeing really increasing, and in two forms. One, we're seeing it from the aspect of just figuring out what those are, and then second of all, actually an increase in automation and an increase in speed of payments. Love to hear from you, Neil, for starters, is what are you seeing there? Are you seeing that, you're a very money focused in the sense of exchange, getting in and out on the betting, et cetera. What are you seeing from a velocity of money point of view?
Well, it is a major issue for us. We have, at any one time, we have substantial amounts of cash with intermediaries, such as Visa and MasterCard merchants. So trying to drive that down, and that's going to get an increased focus. It already gets focus, but we're going to have more focus on that. Obviously, we're looking at counterparty risk here for our payment providers. So that is definitely something which I'm going to get it. I'm certainly going to have a closer eye on. It's not something historically which has fallen into the treasury area. We have a separate team managing that. But I think that's something where, as you said, the integration of treasury with other parts of the business is becoming more critical.
And what about electronic currency? Something that's going to impact you guys? Are you guys looking at that at all? And I'm not talking about the Bitcoins. I'm more talking about, and maybe you are, I'd love to hear that, but I'm talking about more, you just saw China issuing electronic currencies in 4 cities. They're going to expand that. You're seeing the United States looking at issuing its own electronic dollar. What are you guys seeing there?
That's something which is on the bleeding edge. So I mean, unless it's got substantial interest from customers, it was something we would only bring in at a later stage. So for example, we're not really in things such as Bitcoin just because you haven't got the volume of customers who are interested in that particular area. So it is something we have a watching eye, but ours is very much, what payment methods can be used in particular countries. It's not something which is standardized across all countries, and making sure that we've got the major ones in place. There can be issues for us in terms of certain countries where, because it's a gaming transaction, it's regarded as high risk for payments. So that's often more of a challenge as rather than going for the more exciting solutions that are available.
Very interesting. All right, David, love to come back to you about the thoughts on the velocity of money.
Yeah, again, I think it's an interesting sort of topic. I mean, I think probably the starting point is, traditionally, management teams are very much focused on sort of top line sales and, bottom line impact. And again, I think, this crisis is very much sort of focused attention on sort of, cash conversion and how quickly that sort of happens. And I think, there's a few things, we are seeing. So certainly, we're seeing teams, going back, revisiting their supplier payment terms and just making sure, are they really, are they benchmark, are they achieving sort of top quartiles or benchmark performance against their peers? Actively engaging in those negotiations with suppliers to get extensions where they can. Some of those are permanent, some of those are sort of temporary, just to go through the process. And then also manually, unilaterally sort of stretching as well. And then sort of going through sort of similar processes with on sort of customer side in terms of looking at sort of going back through the sort of dunning process, payment terms, and so on, and thinking how they can sort of collect cash quicker. I think what that is being balanced with, though, is we're seeing a sort of a balanced approach to people also wanting to protect and secure their supply chain and also protect and secure their customers. So we're seeing companies really trying to walk a tightrope here between the risk of going too hard on the suppliers and you risk a critical supplier falling over, and then suddenly you lose that critical service or lose that critical product coming to the organization. Likewise, on the customer side, again, really trying to sort of balance the messaging there and being sort of more supportive and not being aggressive. Because I think, we are in a time where people will remember how we all, as individuals and all as companies, responded and acted during this crisis. So I think companies are really, it's difficult. It's trying to push where they can, but not pushing as perhaps aggressively as perhaps certainly we saw during the financial crisis. But I think, certainly people are more acutely aware of it, but very much trying to do it in a balanced way.
Yeah, no, I completely agree. We're definitely seeing that increase as well. And the interplay, as we talked about earlier. One of the topics, and I think this is pretty interesting as well, obviously, passion of mine, I have to say, is foreign exchange. So let's talk about that in a minute. We talked about debt maturities. We talked about forecasting, the 13-week forecast, the longer out. How do we think about it? David, you talked about operationalization and really looking at whether the business model is still correct or how it needs to be adjusted. Let's talk a little bit about foreign exchange. On your side, Neil, lots of countries. What are you doing on the risk management portion of that?
Yeah, I mean, the major, well, where most of our sort of strategic foreign exchange comes from is tapping into the most efficient debt markets and then swapping into our desired currency for borrowing. So we do have dollar debt, and we swap all that into euros because that's predominantly where most of our cash flows are coming from, or surrogate currencies thereof. Dollars, we don't really have any cash flow, so we do have some currency swaps in place for that. I mean, one of the things we've noted here, of course, with the elevated financing cost now for credits such as ourselves, that will have implications for cost efficiency on foreign exchange and swaps. So the spreads will likely move out slightly because of the credit risk on the treasury organization of the companies such as ourselves. So we don't hedge cash flows from other jurisdictions because of they can be quite volatile, and we take the view that is what the what our investors are buying into as a company which has got revenues generated from many different countries. So it's not something we choose to hedge, I should say.
Yeah, so what we've seen with lots of customers is that there's actually been a shift of focus. We've seen people who look at their monetary asset liabilities, obviously thinking about the traditional, at least, way of looking at balance sheets without the net investments, so the balance sheet exposures without net investments, and then we're looking at cash flows, cash flow, right? So under the cash flow hedging, what we've seen is people are really bringing those back in a lot. So in other words, if they were looking out 12 to 24 months, they're bringing those significantly, and in some cases actually say we're not going to manage the cash flow forecasting right now because we don't know what this is going to look like. But what they are doing is they're heavily emphasizing on the monetary assets liabilities that they want to be very protected on the balance sheet, because what they're saying is that these ratios, the covenants that we talked about earlier, are impacted by foreign exchange at the end of the day, right? So looking at what that is and exactly going in, we've seen a significant increase in hedge ratios from where 80% is just not acceptable anymore, more to the 95 to 99%. And what's interesting also about that is we're going through companies, and one of the things that is done pretty frequently now, more so, and we have the technology for this, is to really look at interest rate differential versus the risk of the portfolio of exposures. So what we're seeing there is that with the interest rates shifting significantly and with the risk shifting significantly, the historic ratio of interest rate differentials versus values at risk have significantly changed, to the point that existing customers are reviewing even that more frequently, and a lot more people want to take another look at that. From and you touched a little bit about this as well, David, from your perspective, what are you guys seeing there, and where are you recommending on that area?
Yeah, I mean, on the FX side, again, we over the last few months, we saw a lot of volatility around that, special exposures to USD. I think that certainly sort of calmed down now. I think really what we're seeing at the moment is people or companies starting to think about what is their future sort of organisation look like, what is new normal. So it comes back to what supply chain, what do we want, what exposures to which suppliers in which countries, which markets do we want to be active in. So I think this whole situation has really made people sort of take a step back and just reevaluate their sort of operating model. And I think that will then drive the conversations around sort of the FX contract sort of going forwards. I think in terms of the hedging, I mean, certainly what we saw with the volatility a few months ago, or over the last sort of couple of months, we didn't see that sort of driving desires to go out and sort of re-hedge sort of immediately. So certainly no sort of knee-jerk reactions. Like I said, I think it will certainly become part of that strategic planning as organisations think through, get through this, make it through sort of 2020, and really start to think through, okay, what's the optimal model for our business going forwards? Where do we want to play? And therefore, I think that will then sort of start to drive conversations around the right hedging contracts in place, the right financing structures to have in place to support that, in terms of whether it's term debt, supply chain financing, ABLs, etc., etc. And then also thinking, I think then sort of hedging will then sort of feed into that and help support that sort of that strategic decision making.
Yeah, that's interesting.
Okay.
Yeah, please.
Sorry to interrupt. I know I'm sort of mindful we're actually coming to almost the session. A few questions from participants. If I could ask Neil one of the questions for you. Neil is, have you reviewed where you hold cash or moved cash from as a result of the crisis?
Yes, well, we have done that. I mean, as I said, we were using credit ratings as our way of establishing counterparty risk, and then we dropped that temporarily and moved to credit default swaps, and then we did restructure where our deposits were held. So as I said, they moved into AAA money market funds. And again, I said that the key here was obviously we're maximizing the centralization of cash. So there wasn't any great need to suddenly start trying to pull cash out from various jurisdictions. We already had it at the centre to the extent that we could already do that.
So were you pulling pretty much every time from every single overseas location, or you've increased?
We always do that as by default. We regard the central treasury company as the bank of first resort for the group, and that cash is an asset of the centre, not an asset of the operations. The business operations are there to to generate EBITDA, but not to sit on the cash. So that's also understood by the group as a whole.
Okay, and then one more question, both for Neil and probably for David as well. What immediate steps should treasurers take to ensure the adequacy of their liquidity position? Neil?
Sorry, Naresh, could you repeat the question? I couldn't quite hear that.
Yeah, of course. Yeah, what immediate steps should treasurers take to ensure the adequacy of their liquidity position?
Yeah, shall I take that one, or it's probably more focused at me? So, I mean, as I said, for us, it was the covenant was the first thing. Make sure that that our revolving credit facility it is usable fully. So I would say that was the key thing, and then obviously generating, for ourselves, a 2-year cash flow forecast with various scenario planning built into that. So that was probably off the top, and then of course then there's the secondary elements about centralizing cash, ensuring that your counterparties are sufficient quality, that that you're not going to get a Lehman Brothers kind of situation. So I'd probably say that was in summary what we did in the immediate aftermath.
I guess listening to what you said around looking at your AP payments, aggregating them and increasing the seniority of sign-off.
Yes, there was
something which you think we should be doing in their roles as well.
Yes, that's correct. I mean, I guess that often is a procurement activity as well. So it's a combination of, but it's probably driven more by procurement, and then treasury would have elements to it as well in terms of supporting that. Yeah.
Okay, I'm mindful we're sort of into a bit of overtime, but if everyone's got, I don't know, one or two sort of closing remarks they want to share, and then I'll sort of wrap.
David, you want to start?
Yeah, sure. I mean, I think just a few sort of takeaways, we've picked up is, one, it's, the role of the treasurer is changing. We are seeing it shifting more into that sort of strategic role, a coordinated role. I think just building on the points that Neil just made there about, how do you manage the suppliers? One of the things we're seeing increasingly is companies establishing cash control towers, which can be sort of managed and led by the treasurer, but with, stakeholders around from finance, from procurement, from sales, and using those forums to actively on a weekly basis manage, review, manage the 13-week cash flow, managing the payments going out, managing the collections coming in, managing the new orders that the organisation is looking to make. So I think my sort of key sort of takeaway here is I think it's really important as treasurers that the whole role is sort of shifting towards that strategic role. So in addition to supporting around traditional activities around the FX hedgings, looking at the financing, etc., it's becoming much more central to the overall strategic thinking of the organisation in terms of managing cash today, planning for the future, and then supporting and driving those improvement activities around the organisation. And I think for me, it's a very exciting time for treasurers today and going forwards.
Agreed. From my perspective, really quickly, a couple things here. One is, I think, to David's point as well, at the end of the day, I think what's exciting about treasury is that it's really transforming into a liquidity as a dynamic vehicle for growth and value creation. I think that's really important. Secondly, is automation is becoming mandatory because things are just going to speed up, and the visibility of data, et cetera, is mandatory at this point. And then third, really, I think one of the things that was kind of been an undertone here is as practitioners and everybody is thinking about the suppliers that they want to use, is to really make sure that they're using suppliers that they know can be there after the crisis. I think that's more important than it ever has, and hasn't been as focused as it has in the last 3 months about also visibility, credibility of the organization that's going to supply the technologies, etc. So those kind of 3 takeaways on my part. Neil?
Yeah, I would echo everything you say there. Also, as I said, the element about having a good organizational structure so that you've got short communication lines, that the relevant specialist groups are working closely together all the time, and so there's a natural follow-on in conversation. The automation is critical. As I said, we needed to provide those cash flow forecasts, and we have those integrated with our monthly accounting numbers as well, so that they tie in together, and that gives confidence to the board that those numbers are reliable and predictable. So I'd echo everything you're saying as well.
Well, that's great. I hope everyone's found this session useful as you develop your own liquidity action plans. Thank you all very much for the questions. I didn't get the chance to do all of them. A very large number of participants, but we'll be able to continue the conversation in the event, so please do tune in. Also, please take time to the search. Your feedback is really helpful to us when we arrange future events. And I'd like to end by thanking Wolfgang, Neil, and David, and Kyriba as sponsors. Thank you, have a good evening, and hopefully see you all tomorrow.
Thank you, stay safe.
Thank you.
Thank you.